Hi, Elle. How you doing?
I'm well, thanks. How are you?
Good. Just been on the road lately, so it is good to find some time to have a chat.
Right. Well, good. It's been a big week. Amazon, Microsoft, Meta, and Apple have all released their earnings in the past couple of days. And I wanted to start off by talking about Microsoft because they beat on both top and bottom line.
Yeah, it was a huge result. So it seems like uh, there's often like a rhythm in markets before earnings, where before earnings you're like got maximum uncertainty over that 3 month period, and the big tech companies pull back their buying. Remember, these guys are all buying huge amounts of stock on the market. And people argue about whether markets are zero sum or not. One of the ways in which they're not zero sum is when companies make money and then buy their own stock. Fund managers are just trading with each other. It's basically zero sum, but whether it's buybacks, dividends, there's takeouts. There's a number of ways that like other money comes in or out of the system, and buybacks are one of the way that money goes into the system. So it's interesting, like this rhythm we've seen so many times over the last decade, where things get really shaky in the lead up to earnings, and then the buybacks stop. There's that buyback blackout window, and then big tech comes out, everything's going great, the buybacks switch back on, and then the whole market steadies. And I feel like this might be one of those textbook moments. Um,
Right, and Microsoft announced a $40 billion share buyback in their earnings release.
Yeah, it's huge. And this is a company that made 32 billion in the quarter, and that's up, 19% constant currency. So that is a beast of a company. Talk about growth numbers. Another company that reported that we could talk about is Block or Square. Their growth basically collapsed. So if you're a tech manager and you've got a company like Microsoft, which everybody understands on a deep personal level how ingrained Word and those kinds of the Office suite and all their products are, and EPS is still growing at 19%. I mean, that's really hard to beat for anybody in the market, whether you're an active manager. Obviously, in Australia and around the world, everyone's got a lot more interested in credit. When base interest rates went up and you get a margin on top of that, those credit products went from being a few percent to, 9 to 12% returns. But even those, when you've got something like Microsoft compounding at 19%, it's hard to beat. And particularly in the context of the sell-off that it saw, like it didn't fall down quite as much as others. And I'm looking at it now, and it's basically almost completely recovered. You went from 450 to 350. Like that was a big, pretty decent dip, as they say. So 450 to 350, and now it's basically 425. So not only did you have all the high quality, the lock in of Microsoft, their leadership as well in AI, 19% EPS growth, but you also had a rare, over 25% sell off, um, just in the last few weeks. So I think it's very steadying for the market to see these companies come through with results like that again.
It is so interesting how attitudes change right before and right after earnings are released because EPS reported above at $3.46 instead of the expected $3.22. So use has grown 31% year over year. I think now over 65% of Fortune 500 companies have implemented it. Things are looking really positive for them overall. How do you think that's going to influence the software space in general?
Look, I think the thing that's most interesting is how does it affect software investors when you have a company like Microsoft growing so fast. Atlassian reported just last night as well. To give an example of what's going on elsewhere in the software space, they recorded revenue of 14% year on year, and a gap operating loss. So then again, compare the kind of cloud business of Microsoft at over 30%. That's way ahead of the old growth companies. Like if you think about the growth companies, the software companies, the SaaS companies that were so popular in 2021, if you want that kind of growth, you're better off in the big tech companies. And I think you're going to continue like the companies that haven't recovered are the ones that they're only really profitable if you exclude stock comp. And I think that debate was won and lost, years ago. You have to include stock comp, and if you're growing below 10% or below 15%, you're not really a growth company in the same way either. So I think the rotation into big tech is going to continue. That means the high quality funds outperform. That means, remember, most of the money, a lot of money, or certainly a lot of money sits in big institutions and in wealth managers. The drive and the pressure just to put that tech exposure in the NASDAQ 100 will continue. I mean, why not have a diversified portfolio of like Microsoft, Google, Amazon? Really most of the funds performing are doing that anyway, and you can get it for free. So I think this continues that trend where small and mid cap tech companies, unless they're growing exceptionally or really stand up performers, continue to underperform. and these big tech monsters, buying Microsoft case buying back nearly $10 billion worth of stock a quarter, um, they're just going to outperform in terms of what most people are looking for from an investment. 19% EPS growth with Microsoft's lock-in quality, it's hard to beat.
Absolutely. And you mentioned Amazon. They also reported pretty positively in the last couple of days. I believe their revenue beat guidance by about $1 billion. Their operating income has increased quite a bit year over year. So they're now at 15.3 billion for that. Interestingly, I think some things moved around internally about where their revenue is coming from primarily in terms of advertising. And that's been a section that they've really been building on.
Yeah, definitely. I mean, remember this was one of those companies that was not profitable for a long time. Cash flow profitable, but not necessarily net income profitable. But now you look at their operating income, operating margin, it's like 12%. So it is profitable. I guess with Amazon, the big question for everybody was, how does it fit with the trade wars? Like of all the big tech companies, actually Apple was probably the most exposed with all their manufacturing in China, by a long way. There's a huge amount of Amazon business that is Chinese product shipped to the United States. Question is how much of an impact would this be? And the answer seems to be not a huge amount. Probably partly due to a lot of their money being domestic. Lots of alternatives, like if you need to buy something, whether you buy it from one country or another, probably doesn't matter too much. The fact cloud business is such a huge part of what they do. Yeah, I think this is one that they could have said some scary things about trade wars and how much it was going to impact them, and they didn't. So I think that's also steadying and a net positive. And it really wouldn't surprise me, again, if markets really settle after these results.
Right. And what did you think of them reinvesting with no dividend or buybacks? I thought that was quite interesting.
No dividends or buybacks. I think their CapEx went up significantly. So they're optimizing for that. And weirdly, Amazon, I mean, we talk about buybacks and dividends, it makes a huge difference to the market, right? The fact that some of the companies are buying back stock, but it really doesn't. If you've got a good story to tell, investors can understand why you're investing. That's completely fine in financial markets as well. It's just Amazon's always been a bit different like that, right? It's never been like Google's always been, for example, has always been more profitable, Meta more profitable, buying back heaps of stock. Amazon was always kind of a different beast. But I would also note that, Amazon's still down 21%. Whereas some companies have recovered much stronger, certainly the big tech space. The fact that it's not paying back dividends, it's got more question marks around it. You can see that in the financial performance of the stock as well. It's not such a clear winner as Microsoft has been when they come out with a result like that. And they're not going to have the same buyback support that the highly profitable tech companies will have. And I guess we also had obviously we've talked about a couple of big tech companies, but Meta/Facebook reported as well.
Right. Their EPS is up 100% year over year. Their revenue was 36.5 billion, and they have a massive focus on AI right now, which is quite interesting to see all of the big players all competing with all of their internal AIs.
Yeah, definitely. I mean, like their AI investment is interesting because they've obviously got a relatively open model in the Llama family. They're not monetizing in the same way that OpenAI is by charging. They've always been very heavy AI because machine learning about showing you what you should put next on your feed. They've got 3.4 billion users now, monthly active users, which is a huge number. It's a significant portion of the world. And they show each of us an individual personalized feed over what we personally are most likely to like, and showing us ads that we will personally most likely to click on. So, they're advanced. Every time they advance in machine learning, it massively drives up their revenue and also makes their products extremely addictive, which I'm certainly guilty of. But plenty of people that criticize them for that, for the way that they've used those tools in the dark arts to keep you locked onto your phone. Whereas obviously if you actually stepped aside and said, how much time do I actually want to spend on Facebook, Instagram in my life, the answer would probably be very little. But I guess what people say and what they do are very different things. But yeah, another huge result. So again, you got another one. So revenue growth of 16%, so higher than some of the other growth stocks that aren't profitable. And margin expanded, top line 16%, bottom line 37%, and diluted EPS. So that's again, it's a hard bar to beat. So why do we go for like fast growing companies, for example? I mean, I don't really believe there's that much space in active management for just buying big tech companies. It's not a case of just being different for different sake. I think because there's such a really good, effectively free way of doing it, most people should keep the bulk of their money, for the exposure to these companies, it should be the NASDAQ 100. It's just a nice mix of 100 companies heavily weighted towards the ones we've just discussed that are doing best. That kind of rose through the ranks of the NASDAQ 100 too. That's a great way of doing it. I think you could outperform in sell-offs by holding more Microsoft usually, but there's better ways for investors to access it. I find it hard to find a place for an unprofitable company growing at 10, 15%, which where some of these companies like Block, find themselves in now, where they're not profitable, they're not buying back stock, they're actually diluting massively. So you've got mass net insider selling, every quarter as stock vests. But you're not profitable, you're not growing. So, these companies set a really, really high bar, and they're not crazily valued. Like this is a forward P of 20. It's actually cheaper than a lot of companies as well. So I think this earnings season has really emphasized how, I mean, we could say this at any time in the last 15 years, but these companies, 10, 15 years, these companies are absolute beasts, monsters. There's maximum uncertainty before they report. There's maximum pressure on the market when they're not selling stock. So when they're not buying back stock and insiders are selling everywhere else. And there's often a moment of relief afterwards when continues to go well, and those huge buybacks switch back on. Yeah, it's really interesting. I think that's going to help steady markets in a big way. You could turn to Block now because I think that's interesting. Like it's because obviously the Afterpay acquisition, a lot of Australians became shareholders. Their gross profit grew 9% year on year. It's sometimes hard because they have crypto money that comes and goes. Their Cash App gross profit grew 10% year on year. It's just not really enough, in my opinion, to be excited about. And there's so many fintech competitors now. Like there's so many different apps you can put money in, you can transact in. There's really good international ones as well. The bear case in Square was always that they were like bad customers, and they're only in like kind of the Cash App was mostly used in the southern states and kind of low income areas anyway. Yeah, I guess with Block you also have to kind of strip out their Bitcoin revenue, or at least kind of smooth out what you think they can make long term. But looking at their numbers now, 133 mil cash from operating activities, but the stock comp was 315. So, that's even their cash flow isn't that great after you strip out share-based compensation at the moment. Now, there might be a few one-offs in there and movements, but it's not a clear, easy story. And when you think about the companies we just talked about, whether it's particularly something like Facebook, Google, or Microsoft, I think they're crystal clear stories, and in a sell-off got really cheap. So I think those three are by far the strongest. Apple is confusing because Apple has huge exposures to China. So there's just like an unknown. Obviously if smartphones were excluded, but if tariffs were included there, or if the Chinese retaliated somehow, that would be bad. They're probably going to have to invest heavily in non-China manufacturing. They already were, but that's probably going to have to be accelerated because a company that size can't just be so reliant on one country. And I'd say they've still had this issue where they're almost post-growth. They've like struggled to grow. Services is growing, but people are buying iPhones less. The form factor of iPhones is kind of steadied. And weirdly, they haven't really done anything in AI. Like Siri is on so many phones, and if that was a half decent product, like everybody would use it. But it's just dumb as a rock, as somebody once famously said. It really is. Like Siri has no idea. It's not even like first gen. Like it's not even like Chat GPT-3. It has no idea of what's going on. Just annoys people. And they've clearly decided it's just too risky to go down that path or been unable to make it work. That there are risks. Like you have to get even the very best AIs make mistakes. They hallucinate. Voice can be misinterpreted. Just recording people's voices and converting it to text for the model has errors. And the moment the stakes are extremely low, so you can't really do any damage with Siri, but you potentially could if you invest it. But I think it's a risk they're gonna have to take because they're just falling behind. The second they switch on a decent AI product, they'll be able to start collecting data and improving it. Same way they did Apple Maps, where it was just atrocious. But they had to get it out there. They had to get it out there, get people using it, see where the errors were, fix them, and now it's roughly equivalent to Google Maps, to all intents and purposes. They need to take that kind of risk again. Turning to Australia, I thought it was super interesting. So as we read, Clarity Pharmaceuticals, which we took a large position in, is up 14%. So bottom out $1.45. We bought some there, but really we averaged our position at around $1.70. All the shares we were buying. It's now $2.60, so it's almost up, say 90% from the lows. And we can see the short interest has gone up massively. So it's like 8% and it's delayed. It could be 9 or 10% now. And so people were shorting heavily. You can see on the day that they've shorted, and they're shorting heavily on all those days. Now, if you're down 90% on a short, you're in a really tight spot because it's very hard, particularly if you're a bearish person, you think markets are going down or certainly not going up. It's very hard to make 90%, you know? It's hard to find those doubles. They kind of happen, they don't happen very often. When they do, it's usually in like a bull market every year or so. Um, and so if you lose 100% on a short, it's very hard to make it back. And if you're selling to the whole, even if you're selling extremely well and shorting, you know, 8, 7, $6, as you start selling at $1.50, $2, you really lower your average price. And the short sellers will have to hold now through the head-to-head data readout in diagnostics, probably a phase 3 readout in diagnostics. And these are trials that have been done, you know, there's been a lot of work done already. So we already know that the products work very well. It's just a question of how well they work, meaningful. And there'll also potentially be updates from their therapeutic, which have all been extremely good. So holding a short position through those moments, I think, is difficult. And this stock is liquid, but it's not liquid enough to just buy back 10% of the market cap on market. You know, it's almost like when markets top, you really want to be one of the first ones out. It's kind of the same with shorts. You do not want to be the last short out here, because as people fold, they're just going to have to buy back higher and higher prices. And then remember, they're two $10 billion opportunities. The real bear case here is that they're undercapitalized relative to that opportunity. But, you know, for most of last year, capital markets were entirely open to them. I'd argue capital markets are open to them now. It's just a case of whether or not they want to do it. Um, but, you know, you could blink and that's back at $4 or $5, well over $1 billion market cap. And all of a sudden, 100 or even a $200 million raise is very possible. You know, as West shareholders, that's the kind of move I like to see. As a shareholder, you really want management to like optimize the cap raises, not raise money, as little discount as possible. I think like a big bold capital raise is exactly what this company needs, just to be fully funded to go after their opportunities. And I think it sends a really strong signal about how credible those opportunities are and how serious they are about tackling them. If you have a lot of cash on your balance sheet, you know, if you're funded out to 2 to 3 years of aggressive phase 3 trials and potentially product launches, I reckon it sends the right message.
Do you see Clarity being able to stretch their cash for another 2 to 3 years after a raise?
Definitely not. No, they're not. They're not there. I mean, they cancelled a few programs that are non-core, and they made some cost cuts. That probably adds an extra 2 to 3 months, maybe. And again, I don't know their business plan. That's just estimates that I've seen. It's probably sometime next year. They probably have cash to sometime next year. But really, you also don't want to get too close to that either, right? My guess, the head-to-head trial they're doing for Facilities Emmett, I don't think they would have done that if they weren't extremely confident in the results. I mean, it's diagnostics. It's not some random drug that might hit some other receptor and cause some side effect in like 1 in 100 patients, you know, which is typically often what kills drugs. This is something that's worked before. It's like radiopharmaceuticals. There's no reason not to expect it to work again. They originally saw like existing standard of care sees 4 to 5 millimeter metastases. They got down to 2 millimeters, which means you can catch them much earlier, which means that they were changing the treatment plan in like half of patients roughly. If they see that again, then that would be extremely positive. And it's a proper head-to-head. It's not like a phase 3. It's investigator-led. It's not the same size. It's not enough to get a drug approved, this kind of trial, but it just adds to that growing body of evidence. And often they're not done. Often people don't do head-to-heads if they can avoid it against competitors. They'll do head-to-head against like an existing standard of care, not like the other they're generally trying to avoid going head-to-head against competitors. So if that comes through, that's actually not that far away at all. That's like months away. That could potentially be a good time to do a raise. But if I had to guess, I'd say that happens. Another option would be later in the year as patient data comes through, assuming it's as good as it was in the first, you know, dose escalation part. There should be updates then that can be used just to confirm, just to add to the growing body of evidence that the treatment as well as the diagnostic works. And that could also is enough to raise on the back on. So I think that's what we'll see. But once that capital overhang goes, then I really think the short thesis goes away. And if you've got 10% short, and you know, we know Alan does not want to kind of give any stock to the shareholders, even though there actually is a case to giving stock to shareholders in these situations, because basically if you give stock to shareholders, they basically cancel their short and that's kind of done. If you give stock to an investor, they might just sell the stock. So at least with the short sellers, you know, they're probably not going to short again. I mean, they might, but they're not going to short in the immediate aftermath. I reckon when this company raises, the capital overhang goes, everyone can just focus on the data and that bear case kind of vanishes. So I think that's what we see in the next 6 months, but this has really been momentum. We called it momentum unwind. It was a momentum rally up in a straight line, basically 8 times, a momentum unwind down 75%. And I think it's going to continue to trade like that. So now it's flipping the other way. And in all that short selling, there was a turn at the bottom. There were 4 up days in a row. And again, this is like, it seems weird to be talking about this old school market stuff. But, there were 4 up days in a row. That's often the kind of thing that marks changing momentum. And we know that there was heavy selling, heavy short selling on those days. So even on those days with heavy short selling, when everyone was freaking out, stock rose 4 days in a row. And then lo and behold, a week or two later, it's up another 50, 60%. So I think we're on the right side of momentum again, which is good. And I think as far as I've spoken to short sellers, as far as I know, we understand their bear case. And the key part of that will be the timing around the raise. I'm probably more confident than most that their diagnostic has a real chance of tackling that $10 billion market. Also that, there's 2 companies with $10 billion market caps, probably a better way of putting it. I'm probably more confident than most there. I think the data on therapeutics is extremely strong. Also very confident there. The only caveat is it's competitive space. But, I think where I've got more confidence again than most short sellers and investors I've spoken to is I think it definitely finds a role. The fact that they're able to significantly improve outcomes in some people who've failed all prior lines, including other lines of radiotherapy and experimental therapies. The fact that it's helping those late line patients, I think it finds a role at the absolute, worst case scenario. But best case, it moves up early in the treatment line and becomes potentially a multi-billion-dollar product, which would be great.
What does it take to move a product to earlier lines of treatment instead of waiting until the very end? What needs to be proven for people to implement it earlier off and for possibly healthier patients, which I'm sure is going to affect the efficacy?
Yeah. I mean, there's 2 points there. So on the efficacy, the hope is that if you do it earlier, people will just be cured naturally. It'll work. Like the challenge is you have to start on the late line. Like let's say you've got somebody who's been treating patients. Generally, if you're leading a practice, probably 20 years plus experience, potentially 30 or 40 years, They're not conservative for the wrong reason. They're conservative because they know something works and you're playing with people's lives. And there's been a huge, robust amount of evidence and their own experience that shows them that the current standard of care is the best way forward. Obviously, cases will vary. Some people do better on it. Some people do worse. There's a growing body of evidence. Challenge is you need to first prove yourself in the sickest patients that have done through all that and haven't been in the lucky few that got cured. You have to try on the sickest patients. And that's a problem because what if you've got something that really works, but by the time people are so sick, it doesn't work. It's very hard. Often you're treating very sick patients. It's like with Syntara and Clarity, what's given us extra confidence is that they have been able to treat those extremely sick patients. But there probably are many drugs in existence that would work in earlier stages, but never got the chance because they only ever tried in patients in their final line. There's just no way around it though. It just has to be that. And then you have to start doing the head-to-heads to try and move it up. You have to do additional studies. The drug's already approved, like Pluvicto, which did $1.5 billion US. And then you have to say, okay, let's try it pre-chemo. We know chemo works in some patients. Some patients will be cured afterwards. So we can't delay that. And it would potentially be unethical to put them in a trial where they didn't get that and they got some new experimental treatment first. But obviously, it is ethical if it's done in a structured way, and there's a good prospect that it's a better treatment. And if it proves not to work, then you can potentially stop the trial early. Or if it works extremely well, you can potentially stop the trial early and give it to everybody on the placebo as well. Like it just has to be done slowly and structured in a structured way, and it takes months to approve these trials, months to recruit them, months to years to approve, months to years to treat. When the trial results come in, it takes months to analyze, months to be approved, months to be rolled out. Like the whole thing is so painfully slow, and it's painfully slow as an investor because you have to fund all those periods. You have to fund them, and no doubt extremely painful for the company as well. But from an investor perspective, the extra 3 to 6 months can be huge. It's like could be $50 or $100 million of extra capital required, and there's not that many people that want to fund these things. Certainly after big collapses. So it has to be done very carefully, very slowly, very scientifically. That is good. That's actually how you want this stuff to work. And so it's painfully slow, but it's good that you can go to a doctor and you know that what they're giving you and the way they're treating you has huge amount of evidence behind it, and the bar is extremely high for them to be giving you some drug, particularly because these radiopharmaceuticals aren't too bad, but obviously most treatments for oncology are pretty toxic stuff. Like you certainly wouldn't give it to somebody who was healthy who didn't absolutely need it. So the positive is that you have that huge clinical body of evidence over standard of care. The challenge is it's really hard to replace it.
Right. And what do you think of the GDP numbers right now?
Yeah, there are a few interesting prints. I mean, it was technically a negative result. It was minus 0.3%. So it's been a while, and markets sold off pretty heavily. I think accurately because no matter how, there's always ways you cut it. Included this, it didn't include that. It was like obviously some weird things happening with imports and exports. In this case, government was a net detractor, which is rare. Consumption was very strong. Net exports was very much down. Investment was very high. So you could say the positive, look, consumption's high, investment's high. Negative, government down, but we actually want government to go down. And obviously there's weird export movements, not necessarily just in one way. Like, of course, people tried to import a bunch of stuff really early. So I think it remains to be seen. I mean, that's one negative quarter. Let's see what happens next when things roll off. Inflation came in very light. So basically very little inflation in the United States, which fits in with what we saw in like if you look up trueflation, trueflation is sitting at 1.35%, which is roughly matching kind of in line with the figures. So there's not that much inflation and rates are really high. The US Fed rate's over 4%. So yeah, if you have inflation at 1 to 2% or even lower, and inflation's at 4%, that means rates are way too high and they can come down. It's probably true in Australia too. I think people are calling for 50 basis point rate cut, which will be a huge relief to everybody here who's leave it up to their hilts on their houses and homes. Probably makes homes go back up again even more, which probably makes things less affordable. That's, I guess, above our pay grade at the moment. It is good. Yeah, I remember on that day, like GDP down, negative. It was like, oh, the bear case is true. We're going into recession, and then inflation flat. It's like, oh well, at least interest rates will come down, and maybe they'll pump some money into the system, and it's back to the races. So I think that's one where the jury's out. But the positive was consumption investment really hard. If that maintains, I think people will look through at like minus 0.3%. And I also weak markets where they're cutting rates and stimulating is what Druckenmiller, for example, said was the best time to be in markets. When things are red hot, it can be bad. When everybody's pulling money out of everything they can, that's also really bad. But if things are just muddling along and policymakers are doing everything they can to stimulate the economy, and other than tariffs, you can be sure that it's exactly what the US administration is doing. Central bankers now are starting to, there's enough evidence that inflation has fallen and stayed low that there is room to move for central bankers around the world. That's all pretty positive. Combined with the big sell-off, combined with the max, everyone flipping from max long to max short, all the algos short. Those things spend their time flipping from long to short to long to short. Now we're at the short bit. So if it's now or later in the year or early next year at the latest, they're all going to flip long again. My guess is actually with these strong results and the steadiness in markets and the rebound, already the short-term momentum guys have flipped long. Soon the medium-term momentum guys will flip long. VIX has started to fall, so the vol targeters, people that manage exposures based on volatility, they'll start to buy as well. They already would have because the VIX has been falling. All that's lining up for a good like 3 to 6 months. Obviously, nothing lasts forever and nothing moves in a straight line, but I think it's pretty positive. And then in biotech, I think the worst case scenario got priced in. And everybody, funnily enough, because we know there was such heavy short selling in things like Clarity, it wasn't actually like the institutions or the retail. There was actually people were net buying, obviously, like shareholders were net buying, taking the other side of those short sales. If the short sellers have to flip, well, if you're a long-term holder and you didn't sell at $1.40, I don't see why there's no reason for you to sell, right? That's kind of why these momentum things burn out. Like they keep going as the prices get lower and lower. Same as when prices go higher and higher, they suck in more and more momentum buys until there's just no one left to buy, and then if you didn't bought then why would you? You've already either bought it or didn't bought it. Same with Clarity. If you didn't panic on the way down, you're not going to panic now when you're further in line. The share price is rising, and you've got these like exciting readouts coming up. So, yeah, why don't we wrap up there?
Sounds great. Thank you so much, Mike.
Thanks, Elle. Thanks for coming on.